you guys are actual friends? Like,
yes.
Yeah. Tell us about it.
They go tip to tip, these guys. When they hug it out, they do.
Dude.
There's a story behind
That's
that.
a mutual friend of ours, but yeah.
How long do you guys go back?
He told
Wait,
me.
you have a friend named Tip to Tip?
He told me.
That's a great nickname.
We're not going to say who it is.
Starting now.
T2T. We cannot say who it is.
No.
I
told
can
me
tell the story if you want it, Josh.
You tell the story. Don't
Mike's hot.
say the name. Don't say the name.
So we aren't going to say the name, but it's honestly hysterical. It's really, I met Adam. We have a lot of mutual friends. He came to meet me in Fort Lauderdale. We're having lunch. We're a client of his firm. And he goes, this guy, I know him well. We're mutual friends, this, that, and the other thing. And he goes, he's a real tip-to-tip guy. And I said,
what does that mean?
What does that mean? And he goes, you know how when some people hug you and shake your hand, they kind of lean the shoulder to the side? Like he comes in straight and hugs you. And he said, it is full frontal. I could not stop laughing.
I respect that.
The entire lunch.
Yeah.
Oh, no, we both, to be clear, we both really love this guy. Like, it's not.
Love him.
And
I would hope so.
And he's like the only person I would say
now
I
you
know
do.
that he can get away with it. Like it actually,
It's like
it's on brand, it works, and we both love it.
It's a very well-known person.
Yeah.
So you called Rob and said
We were talking about it, and then he called our mutual friend and was like,
Did you laugh hysterically?
Yeah,
when you-
yeah. We were
I could
chuckling.
not.
Because it resonated.
Stop.
He's done it to him too. He's tip to hip, tip to him too. And we kind of,
Most people are tip to hip.
Tip to hip is okay. Tip to tip is a lot.
Does this guy also...
You can't.
No.
He's amazing.
He's amazing.
It's Michael Jordan.
No. I had a great joke that was not appropriate for the airwaves.
Yeah, let's not do that.
Yeah. The equivalent of MJ.
All right, boys, you ready to rock today? Something tells me this is going to be one of the all-timers. It's in the air.
Yeah.
I don't know if it's spring. I don't know if it's you guys. Maybe a little bit of both. I've been looking forward to this all week. What about you?
All month.
All month.
Where's home base for you?
Depends on who's asking, but mostly Florida.
Me.
The IRS.
Mostly Florida.
If you guys don't mind, just the
Oh, yeah.
Oh, sorry.
Bob, you look very smiley. You take an edible before you come on?
No, this is me,
No,
brother.
dude, he's pumped. I'm telling you. It's in the air.
All right.
Oh,
It really is.
Remind me, wire on the right or the left?
Wire on
Thank
your
you.
left.
Thank you.
All right.
Is it smashing down my flow?
You look great. I had flow back in the day. I was a nice 18-year-old. Had some hair. Not anymore.
It's possible again these days.
No,
You
it's
have to-
not.
you have to go
Josh,
to-
is it possible?
No. You have to go to Turkey. Then it's possible. It won't be your hair, though. It'll be from a dog. But you can get it.
You have to decide the dog?
You can get it.
All right, let's pod.
Yeah,
All right.
2 seconds.
2 seconds. So what else is going on, boys?
Oh, I heard a crazy story about you.
You look nervous. You're sweating.
You were doing Closing Bell with Leslie Picker. And right before the segment, you looked up her credentials to make sure that she was up to the level to ask you why you think the market's going up or whatever she's going to ask you.
That's not true.
There's no way.
It's not true?
I did look up her credentials, but that was only because I was trying to just resonate with something about her background. It wasn't to see if they were up to this.
trying to connect
that's
for
just trying to
comfort.
connect.
Sounds
Okay,
crazy.
yeah.
You know, the first time Adam was on, he was super duper sweaty. You
She's
remember
not
that?
she's not mad about
He
it,
was
but she thought it was
super
funny.
Crazy sweaty.
You know,
I really feel bad she took it that way. I was actually impressed with her
Not in a
background.
bad way.
Yeah.
She's just like, all right, am I good now?
No,
So-
she was very impressive. I've been on with her many times before. I just looked her up.
That is awkward.
Because
Let's
sometimes you're
start
like,
the show.
oh, you went to UCLA, do you know, whatever. I was just trying to connect, you know, and I didn't prepare.
I was screwing with her on the commercial breaks. I was looking up. She was up for a Gerald Loeb Award, and I was asking the producers to verify
Who is that?
it. No, can you please verify that Leslie was nominated for this award?
That's hilarious.
Shout to Leslie Picker.
Yeah.
Alrighty.
All right,
I hope she sees that I genuinely
dude,
was
she
looking-
loves you.
All right.
All in the fun.
Friends, episode 239.
Support for this show comes from Public.com. If you're actively involved in your portfolio, you probably catch yourself repeating the same actions. Buying the dip, manually sweeping idle cash, putting on a hedge.
On Public, you can now create AI agents that handle all of these tasks on your behalf Just describe what you want to do in plain English.
Like if the VIX hits 25, buy a put option on the S&P 500.
Or if my cash balance goes above $20,000, move the excess into my direct index. You approve the workflow, and your agent handles the rest.
Monitoring the market, watching your conditions, and executing your strategies exactly as defined, Public is the world's first agentic brokerage, an investing platform driven by your intent, not just your clicks.
Oh, and P.S., you can also get full read and write access to your account via the Public API.
Go to public.com/compound and earn an uncapped 1% match when you transfer your portfolio. That's public.com/compound. Paid for by Public Investing. Brokerage services by Open to the Public Investing Inc. Member FINRA and SIPC. Advisory services by Public Advisors LLC. SEC registered advisor.
Complete disclosures available at public.com/disclosures. Oh, wow. 239. Rob, we've done this 239 times so far. Or 238 going into 239.
And this is my virgin experience.
Yeah, I
I
know.
kind of rank at the
We
bottom,
ran out of people. And
bottom
then
of the order.
All right.
They didn't
Guys,
trust you to go on solo either. They had to like,
Yeah, I need training wheels.
training. Well, if AP is here, we know it's going to be okay. Adam Parker is one of the fan favorites on this show. Let's do your intro first. Adam is the CEO and founder of Trivariate Research. Prior to Trivariate Research, Adam was the founder and lead portfolio manager of Trivariate Capital, an equity long-short hedge fund. Adam is also an investment advisor board member for Rob's firm, NewEdge Wealth. That around. When did you guys first meet?
A few years ago.
All right. And making his first appearance on the Compound and Friends. I'm so excited about this. Rob Sechan is the CEO, managing partner, and co-founder of NewEdge Wealth and co-managing partner of NewEdge Capital Group. Rob was an advisor at Morgan Stanley, a director at Lehman Brothers. It was not his fault. And a director at UBS prior to founding NewEdge. He has been recognized by both Barron's and Forbes as a top 100 financial advisor. Give it up for Adam and Rob. Welcome to the show, guys.
Thank you.
All right. Question 1. No, I'm kidding. We have to start, guys. We have to start with software. There was another blow up overnight and into today in ServiceNow. This seems to be like a recurring nightmare where every week it's another, or every month it's 1, 2, 3 of these stocks. They're already in 50% drawdowns, and then they report what looked like a good quarter on the surface, and they go even lower. Is there an end? Start there. Is there an end in sight? What do you think?
Do you want me to go or do you want me to go?
It's up to you. I'll start. I mean, I'm not ready to call a bottom in the group, but certainly there's
Me
a
either.
lot of value being created. It's oversold. We've owned a lot of positions. As you know, we owned Adobe at one point in time. We keep trying to rotate into the higher quality names, so maybe we can participate if there is a turnaround. But it seems like these stocks are guilty until proven innocent, and this trend of short software, long semis is going to be in place for as long as it's in place. You look at what More Capital always says, every now and then, Louis Bacon, something comes along and knocks you into a different atmosphere. Something came along and knocked them into a different atmosphere, and it's not changing. And it may not be changing for a while, but that doesn't mean that value is not unlocked at some point in the future in the form of earnings that sustain.
It's a good sign. I want to call Fidelity and ask them if they could hide my software positions from me so that when I log in, I don't have to look at them. I already know they're down.
I have a view on this.
Yeah.
And
I assumed you did.
I want
did.
to be kind of like, I feel like I start all my meetings recently with like everything I'm saying could be wrong.
Well,
Just because it feels like the uncertainty is more than normal.
Yeah.
So like, I feel like I got to bookend my comments, but like, and we've had some pretty bad calls this year, I'd say at the sector level. I'm just saying, I'm pretty honest about that. Like we've had some good calls and bad. We've been recommending healthcare. That's been crap. Like I could go through it, but we've been seeing the ball clearly on software. It's a good call we've had. And our call has been when the multiples contract like they have, what comes next is they miss on earnings, and then eventually they miss on sales. And so I'm not surprised on Now at all. It's one of the ones that people love and defend the most. And the reason I think these companies are going to miss on earnings is because the analysts have 80% gross margin and the same net margin every year going forward, 27, 28, 29 in their models. And how are they going to attach all the AI tools that their customers need without some spending? And if you're a JP Morgan CTO or Morgan Stanley CTO, you're going to pressure them on pricing eventually because you're going to realize, well, wait, guys, we can attach our own tools. We have a massive organization. So there may be value gets unlocked, but I think some of the names, but I think what's going on is they miss first on earnings. And then eventually they miss on sales. And what the analysts are so used to doing is saying, I'm calling my CTO contacts. They're telling me they're never getting rid of now. I call the IR guy. We think it's a SaaS apocalypse. We cry on our beer together. And none of that's what's going on. It's not about today's fundamentals. It's about the distribution of outcome in 2030 fundamentals. So some will work and some won't, but the median software company is going to be bad.
So
that's what I think.
UBS finally last week came out and said it's not the bottom, and here's why. We talked to CTOs, and they're all using the same term, cost containment.
Yeah.
None of them are going to accept this automatic roll.
Right, they're going to pressure pricing, right?
But how much of the earnings power of the software group for the last few years has just been like, we are indispensable. We are the system of record for these customers. They can't get rid of us. We also have the ability to raise prices, and nobody does shit. And now it's not so automatic.
I think that's right. And I think the other thing is, like, when it comes to software selection, kind of maybe perversely, the ones you want to buy are the expensive ones. You don't want to buy cheap software.
I heard you saying that. Could you explain what you mean by that?
If you take this premise that, like, maybe we all know individuals are idiots, but the market collectively is smart, right? When you get stocks that get cheap, on average, they're cheap for a reason, which is the probability they're disrupted is higher, right? So the ones that are more expensive, the security software, Cadence and Spinoffs, like, they're more expensive for a reason, which is their technological obsolescence risk is lower. And so when you go back and study, like, what works in the rebound, it's not the slow growing ones that are cheaper, it's the fast growing ones. So some of these are going to work. I kind of view it a little bit like a lot of software is going to turn into like, you know how, like, a company wants to fire 1 million people, so they hire McKinsey, and McKinsey says you should fire 1 million people, and then they fire 1 million people, and they say, yeah, the experts told to do it.
Right.
Some software is going to turn to that, right? Because imagine you're at you're at NewEdge, and you're like, I Claude coded some security, Rob, let's implement it, right?
Yeah.
And then somehow there's a breach of all the advisors, like, you're fired, and he's probably fired for being a dipshit for listening to. So you're just going to pay CrowdStrike or Palo Alto or whatever, just because you have to have an expert in case something goes wrong. Like, you may get some of that happening in software for sure, but the ones that are more expensive for a reason, and that reason is they're less likely to get disrupted.
It's got to be hard, because I know you're Claude coding your face off. I know your team is like my team, like every firm. The people that are involved with tech are going crazy right now at every company in America. It's hard to then look at the board and look at stock prices and be like, I want to fade this.
I'm close with a number of his employees, and one of his guys who's a stock picker comes to a lot of our events, and he won the best stock picker at our main event last year and has crushed it in tech and in
all technology based.
He has crushed it.
He
hope he listens to this. Hope he listens to this. Give him a shout out.
So Jay is his name. He's unbelievably
He's done great.
talented.
Yeah.
But we've leveraged tech throughout the start of our ecosystem. It was a tech-enabled solutions firm. We built NewEdge on top of institutional-grade infrastructure. We didn't start it out of a private bank. It wasn't an idea in my basement. It wasn't built upon my practice. It was built on infrastructure, on rails. And that infrastructure allowed us to bring in technology, plug and play different things, and try them religiously. We rolled out Claude Enterprise to everybody a month ago. So we're trying to be on the front edge of kind of everything we do. In portfolio management, we have a very quantitative approach. You know, I slept at a Holiday Inn last night when I go on TV, because the reality of it is we're sometimes reverse engineering the story out of the math.
Right.
That drives the positioning that we're going into. And you can see a lot of these things, but I am amazed. It's like I have 15 analysts working for me at my fingertips. So when I was a banker back in the days at Morgan Stanley and doing analysis, some MD would come to me, that we'd iterate, and then I'd go back to him 2 days later. I am doing that same thing. We're working on an acquisition right now, several. And I'm doing that same thing, and it's instant feedback. So you can kind of interact.
You just make me think of, he's probably like me, where, like, I just have too many interns, right? Because I say yes, like, can my daughter, can my nephew?
I know the feeling.
The problem is, like, they don't have any skill. It used to be, I'd be like, hey, go tell me all the acquisitions Microsoft made in the last 5 years and summarize what technologies they're buying and selling.
Now they do.
I'll do 2 seconds and go back. So I don't know what they're going to do for the other 9 days and 9 hours and
The
48
intern
minutes.
fans the machine.
You know,
Keep
it's
it
like
close,
it's,
keep it
the
close.
technology's
I
so
would tell
efficient.
you,
No,
I would
yeah.
tell you that the intern now, the average is going to be good to great, and the great is going to be game changing for the enterprise. I just can see efficiency happening
Totally.
all over the place. So while we might not lay anybody off as a result of this, I can tell you our pace of hiring will slowly
I'm
slow.
hearing this everywhere.
And then
Yeah.
ultimately profitability is going to explode as a result of productivity. And I think that's endemic
But so
in
here's
the market.
So here's the problem then. So then here's the problem. You have, I don't know what it is, 150, 200 enterprise SaaS companies in the public markets.
Yep.
Forget about pricing because no one's going to be able to pull off a big enough increase. The real problem is most of these companies are selling by headcount. And what we're all saying here is headcount may not shrink, but it ain't going to grow to the extent that it used to anywhere.
But
for
I'd like
exactly
to know
this
his view on that, because the reality of it is what does that mean for profitability for these companies if they still have essential kind of infrastructure and tools? Doesn't that ultimately make their profitability explode as well? And isn't that a positive thing at some point? And so should we
the
just
software
watch the
companies
earnings?
themselves.
Wait, hold
Yeah.
on. We have charts for this. John, so ironically, throw up chart 5. So ServiceNow reported this morning down 18%. Not bad. We have their headcount by department.
It
So
was my final trade 2 days ago
you
or yesterday
dumb
on the
bastard.
Did you
show.
see the earnings? Have you learned nothing from me?
I do it all the time.
Oh, my
so
God.
yeah, we've all been there. Q1 2025, 26,698 employees. Q1 2026, 29,732. John, go to the next chart. Their stock-based comp is exploding. Like have they not gotten the memo at all that the street does not like this? Look at that.
So
It's breaking out.
SBC didn't matter until it really mattered.
stock-based compensation is now we're going down like the twig, down the branch, down the tree, but like it's just a beta factor. So when tech outperforms, the ones with lots of stock-based comp outperform. When underperforms, the ones with lots underperform. So it's just a beta factor because it's like an R&D intensity factor. But you know, you could have died on that hill. You would have lost a lot of money on the stock-based comp hill over the last 15 years. So you got to manage risk around it. But like, I kind of agree with Rob's point, or big time I agree with it. Like, it's about productivity. And the question is like, what's in the price? Look at Walmart, maybe it's the ultimate poster child. Like, what would make the market go parabolically higher? One of the things would be Walmart gets on, it says, in 2030, we'll have less employees than we have now. Right?
Which might actually end up being the case.
It might, and there's a reason it trades at whatever, 38 times forward earnings. It's not because they have 3.5% net margin or whatever the number is now. It's because you're in the price is 5 or 6 eventually that they're going to nail predicting how many jugs of milk are in every.
I think that's too early. Is his point? We are at the tip of the spear for these companies figuring out whether they can make that migration, figuring out the implications for the business. You guys probably are too. We are too. We're learning as we go, and we're learning at a pace that I've never seen before.
Gee, I wonder why Wall Street hates why the country hates Wall Street. You just said what would make Walmart really go parabolic if they come out and say by 2030 we're going to have less employees.
So economists and stock people have never been more incongruous. Like if you, I remember when I was at Morgan Stanley, our economists would say stuff like, I want capital spending and I want hiring. And I'm thinking, if I own a stock and they announce either of those two things, I'm selling it immediately, right? Like there's a giant disconnect between.
That doesn't sound good.
Right. Like I don't want hiring at my company.
Well,
like you
it's
just
more
pointed out.
potential customers with higher paychecks.
Yeah, that's all bad.
Is one
more healthcare,
Yeah,
more right.
right.
Like, but so the GDP and the economy are kind of different than picking stocks, right? I mean, look, you had a guest on last week or the week before, a personal friend and favorite
Encore.
of mine, Encore Crawford.
Do you know 70,000 people and counting have watched that episode? She
So I've
is
known her
such
for-
a star.
I know her for a really long time.
I met her through you.
And you skipped a couple things about her in her bio. One of which she has a PhD from Stanford, and the other is she has the number one performing growth fund in the last 12 months in the entire of all growth managers.
All right, but
I told her afterward, like, you need to
She's
write
very
props.
modest.
But she said, she said something that is totally awesome. Okay, and I've stolen it from her for the last week, which is people who are like bearish on AI don't get it. Like they if you think like it's a bubble and it's
said
over.
nonsense. She said it's nonsense.
Yeah, and everything sounds smarter when she says it for sure.
Right.
But like I just feel like we're on the precipice of this. Like the reason there's earning estimates that are 18% for the S&P this year and 17 next year and 43 in tech this year and 25 in next year is because you're like in the we might be in the 5th inning of the stocks, but we're in the 1st inning of like it hitting the numbers.
You think that's why small caps are breaking out? Part of the reason?
Yeah, maybe.
You know that the
yeah.
S&P 493, so no Mag 7, earnings are supposed to be up 16%. There's got to be some AI productivity
There's
in there.
got to be.
Has to be.
There's got to be.
Why else would that happen?
No, there is.
It's not 8% GDP growth.
But
Yeah.
there is underlying economic strength, right? There, you can definitely, just if you look at the price action of just about everything, whether it be spreads, it is telling you that there is a miss between positioning and what's happening in the underlying economy. I don't think there's anybody better at reading the tea leaves than Tom Lee. I think we could all agree that this is the best data guy out there. Tom Lee sees around corners. It's freaking unbelievable. And how does he see around corners? He's watching these cross-asset movements, right? And you know, one thing that scared me, you might have said it on your show, is he kind of thinks there's going to be this like mid-year pullback that scares the shit out of everybody.
They're going to test the new Fed chair at some point.
Yeah. So, and
meaning if
I don't know
Marsh
why
says something
Mr.
that the market doesn't expect, there'll be a big overreaction.
Yeah.
Okay.
Yeah. So, but when he's looking at these things and seeing what's happening in, you know, quality names like the semis and what's happening in software, he's listening, and many don't.
Yeah.
Right? Many get sucked up in the headline narrative of what's happening in the war, and they start to think second and third derivative effects of what could be. But what is it?
Yeah.
Today, what is it?
Yeah, I mean, I think if like the way to think about it might be if the street's got 43% earnings for tech, and yeah, a lot of it's Micron and Nvidia, but let's just say it's got 43% growth, and let's say the real number's 30, and it's got 25 next year, and the real number's 15. Tech's not going to be 45% cheaper in a year because it stayed flat for the entire next 12 to 18 months. Like, unless there's a much bigger growth scare coming in 28 or 29 or something, like the odds are just the absolute level of growth is high enough that things work. And so I think the market woke up to that a few weeks ago. But like, where could people be complacent? Like, I did a big risk dinner this week with a bunch of risk officers, and like,
Excited.
nobody thinks, it's not exactly.
Rob wasn't invited to that?
No.
Okay.
Rob.
I wasn't either.
Yeah. Rob, not his crew. But
The
like
annual value at risk dinner.
what people are like, if you say, what are people complacent about? It's probably that everybody thinks oil eventually is going to come lower and probably faster. So like right now, nobody's taking their numbers down for input costs in industrials or for, select, energy sensitive consumer, because they just think, second derivative Hormuz news is positive. If I get bad Hormuz news, market's down 40 bips. If I get good, it's up 150. So like, whatever. It's so
nobody wants to look like an asshole again.
Right,
for going risk off.
You called 17 the last zero, tariff problems.
Right.
So I'm not being the Hormuz problem guy, right? So like people are a little bit, so I'm not saying that's going to happen, but I just think people are playing for, so like on the Fed, like I'm not sure cutting rates is going to be bullish for multiples like it was 3 years ago.
Frankly, how can it even happen? It creates an inflation expectation problem that is going to be pretty dramatic, I think. It's why you have to own some energy in the portfolios. It's kind of like a tail hedge to this.
Do you think most market participants would prefer the price of gasoline go back to 3 and change versus another 25 basis point rate cut? I do.
I do too.
Yeah, for sure.
Yeah.
Yeah.
No doubt.
Well, there's a higher likelihood of that, to Rob's point.
But also, like, it depends where you're on the cycle. Like, when it was the end of 2022, and you perfectly covered your Nvidia, Tesla, and Meta shorts, which are all down 65%, and you started buying them max long on Jan 1,
right?
Your logic...
Actually, it was December that I bought.
You gotta
December
get it.
31st.
You're big, you run a lot, you got to get it. Okay, so then... your logic was, well, the Fed's closer to the end of the hiking cycle than the beginning, eventual accommodation's coming, the Fed action's going to be super bullish for multiples, nailed it, right? But the question is now 3+ years later, if they get incrementally dovish, is that really like, oh, awesome? Or is it because like stuff's slowing and therefore like at some point...
it becomes a growth scheme.
Yeah, it's a little bit different, right?
I'd rather have the gas price come down. Is the semiconductor rally the most out of control thing you've ever seen?
No.
It's not?
No.
I think it's complete.
I think it's justified too.
Is it the most out of control? I've seen a lot of out
I
of
think
control
it's
stuff.
so. I think it's so completely out of control. The pace of it and the relentlessness.
Micron is bigger than Johnson & Johnson.
Okay, so look, I'm a you know, I used to
Hold
be a
on.
semiconductor analyst.
Hold on.
and,
Last 16 days,
Mhm.
35% for the semis. 16 days. It is the best rolling 16-day. I know it's a random number. Best rolling 16-day period in the history of the SMH. Never before.
Yeah.
And I understand the reasons. I don't live in a cave, but
I mean,
people will just buy anything semi-related.
I think
every
when you
single
look
day.
when you look at semis and you look at tech, you really have to look at it like even software. Look at software ex Microsoft and with Microsoft. When you look at semis, you know your tech book is going to look like it grows more slowly and is more expensive than the tech index, unless you're overweight Micron, because Micron trades at 4.5 times next year's earnings and is growing like 100%. Right? So you know we know it's cyclical, but
You got to see something that comes along and challenges
How anticipated
that
you wanna be.
probability of that outcome. And I don't know
of them earning enough.
Right.
Right.
That is right. And as long as
I don't know what that
earnings
thing
get,
is.
it's hard to see right now, but you know the pianos don't hit you in the face; they hit you in the back of the head.
Nvidia has grown earnings substantially in each of the last 4 quarters. Stock has not gone up.
I think the stock will go up and go up a lot.
I
over
know,
the
but I'm
years.
saying
Yeah.
two things can be true.
Yeah.
You can have a stock price that just refuses to go along with incredible fundamental news, which is all we've ever seen from
Micron's
Nvidia.
estimates, plus or minus, I don't know if somebody can, I'm sure somebody will comment on this, but like they were roughly $50 in earnings per share for next year before they reported, and they're roughly 100 now.
Yeah,
Man.
it's
Right. So
unbelievable.
the magnitude, one of the things we're doing right now, we're researching is look at all the companies where 2 years earlier, the analyst estimates were most off, like ever. On
is,
earnings
this,
and cash.
is this high on the list?
And those are the best stocks.
And this guy, in both directions. Look at the ones where they way off too high too, just to see if there's a pattern. But like this is one of the bigger free cash flow estimate misses ever in 25 years in the market.
I want to.
So when you say it's crazy, like the price action is massive, but it's also one of the crazier.
It's crazy
fundamental
because
improvements, too.
it's such a huge change and nobody knew it was coming.
Like rough order of magnitude, people had like $1.5 billion in free cash flow for next year. And it was like $3.5 billion over 2 years, and now it's $80 billion over the 2 years. Like the magnitude is like zeros off.
Yeah.
Adam, I want to do one last thing
sorry.
on software before we leave that. So you have a lot of hedge fund customers. I'm imagining that nobody wants to touch software, although I'm sure there's a lot of dip buyers that got their hand burned. But ServiceNow, for example, so they report this number of customers with $5 million ACV. John, chart 3, please. And they went from 434 customers paying $5 million up to 630 in Q1 with a 97% retention ratio. Now, their margins came down, but this is still a good business.
100%.
The problem is nobody
It sits on the macro. I mean, you're going to have to manage all this.
But the stock
right?
is down 18% today.
Totally
Nobody,
get it. You
Isn't
can't
that
fight
scary?
that.
They did 22% revenue growth. They hit the numbers, and the stock still lost 20% of its value after being down 50-something%.
And
Isn't that scary?
So when you talk to your clients, like, what's their view? Is everybody like, this is uninvestable. How do I buy this?
So the only thing I'd parse in what you asked me is I think it really depends if you're long only or a hedge fund, right? Most hedge fund money, like they don't have to own any of this stuff.
Let's do long only.
Or they can pair off, right? So it's really more the long only guy who's, is what he is. He's a software analyst. Like, why does GM make cars? Like, the software analyst, he's got to pick winners, losers in the group and identify how to like outperform the software benchmark, right? And the PM's job is to figure out what exposure to the aggregate group should be. So I think most analysts are going to say, I want to own stuff where the revenue is accelerating. And, if you look at a 2x2 grid of like, beat on revenue, beat on earnings, missed on rev. The worst bucket is what now reported, which is you find on revenue and you miss on earnings because the market doesn't know where the clearing margins are, but you just expose the fact that like your margins in the out year are lower.
And margins came down. Their guidance for margins came down.
So it's not trading 18% lower today. It might be trading 4% lower on 2030. Like you have to warm yourself up to that idea of like the uncertainty on the margin profile just changed. There are assets, including now could be one of them, and I'm just not smart enough to know that this could be like a great entry point in a 2 or 3 year. But I need to see some price action that we all know are going to shake our head yes, where a company misses and doesn't.
What does that look like?
Down. That's it. That's
I
what
haven't
it is.
seen a
miss and the
single.
stock doesn't move.
I haven't
We're
seen
not
a
there.
single penalty for missing that hasn't been harsh. Right. Today was the first day where I thought a couple beatings were good. URI, Texas Instruments up massive. And, but if we track this thing, the penalty for missing versus reward for beating ratio, and not only has it been very skewed toward the penalty harsher, but it's like cheap stocks missing are going down more than expensive stocks that are missing.
So what type of market does that happen in?
A toppy market.
I think the good news, I guess, is more companies are beating than missing.
Yeah.
So that's why the market's fine. But like, if more companies start missing, like we can't buy stuff where we don't have any evidence. Like the best thing ever is like, the old days, like Caterpillar misses and it's unch, and you're like, all right, game on. Like I mean, missing is unch.
Missing.
Yeah, but we're not seeing it. Missing's annihilated, right?
Yeah.
Put this tech multiple compression chart up. This is a thing. What do you guys make of this? I think it's 7. Here we go. So let me narrate this for the people that are listening, not watching. We're starting in 2020, right around COVID time. We were at 16 times for tech's forward PE ratio. Peak out in the 2021 bubble at 28.7. Fall to a low of 18.5 during the year of efficiency, 2022. Then we rally through 2024. We hit an all-time in this chart, 32 times forward earnings. Drops early 2025 to 21. Back to 31 at the end of 2025, one of the best years ever. And now here we sit at 19. Huge derating on forward earnings.
Very quickly.
Very fast. Very unexpected. I don't remember reading any strategists saying...
Micron's estimates are up 100%. I mean...
Is that all this is? Is the growth rate growing faster than
if the estimates are for 43% growth in earnings this year, then that you can have multiple being high because the E went down or because the E was nudged and the P went up. And in this case, it's more the E
is going up really fast and pricing is.
I'll give you one nugget. If you look at the S&P 500, the whole 500, Q1 26 versus Q1 25, year-over-year growth, 45% of the entire S&P 500's growth was from Micron and Nvidia.
If you believe this geopolitical risk leads to slower economic trajectory, markets are going to pay up for that growth, and you're going to see that go right back up.
Because if there are less companies growing, they'll go right back to the old playbook.
Or just the E. If the E comes in and it's unch on multiple, the stocks will be 40% higher. Like, or Micron will be up or whatever. So it's a multivariable world, and you just showed one variable or whatever the criticism is. Yeah.
What were you telling clients? What did you make of the stair-step lower during the war? The fact that like, the market just wouldn't puke. What was that telling you? I know it's hindsight now, but
it made me more bullish.
Same.
Yeah.
We didn't have a panic. We went lower.
I came into the year.
So that's actually what kept us invested completely through that. Now we did upgrade quality. Like I said, when you get any volatility, it's a great opportunity to kind of pivot to a higher quality name in the same sector that's not getting derated as much or has shown more resilience in their earnings.
Because you say, wait a minute, we can now own this.
Yeah, especially if you're a long only relative investor in a certain class, whether that be dividends, value, growth, and you're kind of managing to a benchmark in a portfolio construct, and you can say, okay, now I can own this. I could never own this. I mean, for so long, we never owned Nvidia until it traded below 30 times earnings. We waited it and we missed a lot in doing that, but boy, did we buy it at the right time. And it's been, so if you can still employ your discipline, and when volatility creates the opportunity to upgrade quality and you can move from X to Y, you do it. And that leads to a lot of outperformance.
Volatility, though, to your point, within a reasonable
band.
Like not a free fall where all of a sudden it's like, wait a minute.
That's that whole different atmosphere thing.
Deliberation. We didn't get that this year.
And you won't get it from geopolitical. You get those from financial issues, right? So this credit issue that we I don't really believe, I know a lot of people do, but I've been an ardent defender of the equity that sits beneath it and the economy being strong enough that these private equity firms are not walking away from these businesses and the credit's going to be fine. And the market's kind of telling you a little more, at least the more public markets, that spreads are remaining contained. And listen, a lot of the credit in private credit sits at the highest tier of the capital stack. So you got to wipe out a lot before they're wiped out, right?
Yeah.
So from my lens, it is that that is more of a concern than anything, because that's the liquidity that feeds the ecosystem that we all thrive off of.
Financial conditions.
Now, I will say that if you cannot raise money going forward, we talked about this on the other show. The reality of it is if your forward ability to raise capital from private investors has been impaired, and that was your growth strategy, right?
Yeah. Toast.
And though they're not coming back right away, but the institutions are staying in because they see the value of this. You're going to be more discerning because you have to be, because you don't have as much capital. And so the strong are going to get stronger. They're going to get financed. And the weak are going to require more investment. And some of them will get
maybe
it.
buy
and
KKR
some
or
of them
something.
won't.
Maybe buy some KKR.
I've thought
those
about
stocks might be
those
bottoming.
sides.
Look at this. So
It might be.
Blackstone.
Yeah, I know.
Yeah.
I mean, maybe Blackstone. I meant,
So
I didn't
Blackstone
know which one,
report-
I didn't know which one you're going to show, but
Blackstone
Yeah,
reported
so
today.
I tax loss sold, not me, the team. Tax loss sold Blackstone. I got a lot of shit on it on the show because I was such a champion of these things, but it was just tax loss.
So you bought something else?
We didn't buy something else in the space, but we would likely go back in to Blackstone.
All right, so Blackstone got whacked off today. It's down 6%. And this is the private credit fundraising on a gross basis by quarter. Okay. Down almost in half, not quite, 3.3 billion in the prior quarter, down to 1.9 billion. This is gross, not net. Okay. So I don't think there were outflows. So a dramatic slowing, but not to
think
zero.
about this.
This is the media narrative pausing people who are about to allocate.
100%.
Of course. I mean,
and it's
it happens
also
all the time.
human nature in advisors, we're advisors, to say, hey, do I want to try to take advantage of this and steer into the eye of the storm? Most people don't do that. Most investors, and the success that we've had as a company, period, is identifying areas where forward returns are headed higher.
But pricing has not come down.
Right, we're
in
not
this
even in the
underlying
storm.
market.
It's a flow storm. That's it.
So that's right. But let's use a different example in when we had the tech crisis and in venture companies having trouble raising money and it re-rated down and they pivoted to venture debt. There was an enormous opportunity in venture debt because they didn't want to sell equity at those levels. And if you steered into that storm just in a different way, right? What it led to is higher forward returns. And you see that episodically in markets. So I think one of the great challenges that advisors have is keeping investors invested, and how you do it is by identifying the high optionality within the underlying crisis.
Right.
They will have a greater probability of success on the other side.
If I read a headline that said 6 months from now, great news, or it would say horrible news, all of these leveraged loans are now trading 20% cheaper than where they were. The thrust of that article would be written as a way to bash the private credit industry.
You go right in.
But then I would say, I love it. I haven't bought any of this shit yet. This is my opportunity.
100%.
I agree with you. I don't think most people think that way, number one. And for financial advisors in particular, what do you think most of their clients would say back to them? Hey, let's buy some of this asset class that the Wall Street Journal is screaming bloody murder over on the cover of the newspaper. Why would we want to do that? That sounds crazy.
And I would say, did you see Blackstone's partners step in to buy, take a gigantic chunk of their own money and buy this? You think they're doing that because they have massive concerns about the asset class?
So KKR just bought $10 million of stock. That's why I mentioned KKR. I didn't know the Blackstone, but I saw they bought.
my
the
son
pushback I got was somebody was like, "Yeah, well, the guys who got $1 billion." I'm like, "Yeah, but people don't like throw $10 million out on purpose. Like, the person's signaling confidence.
But
It's an open market purchase.
But right now, the price with a few obvious examples, it's not like that leveraged loan market is in distress. It isn't. Right. It's not like there are these massive discounts.
But the narrative gets sucked in and pushed out so quickly.
I think I like the equities better than the products. Would be my comment.
For sure.
I like the equities better. I'd rather be a GP. If I could buy KKR and Blackstone at 25%,
I got like pitched a year ago from somebody on a private credit product, and I was looking at it. It was like unlevered 13% private credit return, and I was like,
unlevered,
sorry, I don't want to be like the annoying client, But who's lending to me at 13% unlevered? Because like, how many? I mean, what is this? Is it like nail salons in Orange County? Like, who needs 13% from me? Like this math doesn't make sense. So like, the stocks are probably on a 2-year view, better.
In a
But the
different,
stocks are cut in half. The private credit's still trading 1 for 1.
that's my point.
Right.
You're not getting a discount in the underlying. You sure are getting a discount if you come in at the GP level, buy the stocks.
Yeah.
So, all right, you want to do this chart with the highs?
Yeah, so part of the narrative over the last couple of weeks is, we're hitting all-time highs, which is awesome. Feels good, feels better than being down.
Mm-hmm.
But there's not a ton of stocks making 52-week highs. So this chart is from Jason Gepfert, sentiment trader. So he's looking at the S&P 500 return after the first it's specific, but whatever, after the first record high in 1 month, and under 5% of issues are at a 52-week high. That's kind of odd, under 5%. And it's a mixed bag to down. It's not great.
Yep.
Positive 33% of the time, 1 month out, 33% of the time, 2 month out, 42% of the time, 3 month out, 6 month out. I mean, these are not great numbers. And it's not like one time. This happened, in 29, all right. 83, 90,
29.
93, 95, 2015, and 20.
Do you want me to shit on this, or
Yeah,
do you
please.
Want Rob
Go
to
ahead.
shit?
Please.
Okay. I'll just start by saying I don't think this kind of stuff is helpful for predicting subsequent return. This is not statistically significant. The market's way more concentrated, different than it used to be. You guys are financial advisors. I'm not, but I can empirically show you that any kind of breadth metrics do not effectively help you make money. They're usually volatility gauges. So if I were one of Rob's advisors or Rob, and somebody said, I'd like to time my market entry here, I would say you will destroy value using this kind of data over your career. Whether it's VIX or moving average convergence versus
You don't like probabilistic forward return studies in general.
I know this isn't statistically significant. I know it's not it's all like how relevant is the 1929 data to 2026 second half.
Zero,
All you really said is that there's some big stocks that are up a lot, so not, and not all of them are. Okay.
Good debunk. Let's take a quick look at.
But I want to just caveat, that could work right now. I'm just saying, if you gave me 1,000 of these charts over the next few years, I'll take the under on more than 500.
I actually don't think anybody invests based on that.
No,
I think people use that.
You want to be fully invested in equities. You don't want to make 1 month market calls.
I think people use stuff like that to justify something that they're already going to do anyway.
When it comes
I don't think
time
anybody
to
actually-
buy, I promise you, when it comes time to buy, none of your clients are going to want to buy. So if they were super smart and got out at exactly the right time, they've got to stay in the game.
Totally.
The question is how you're positioning within staying in the game.
Yes.
And I think it's gotten a little tougher because of the index concentration, and you have markets, so you can't kind of pick your spots within that in many cases. And so a lot of times you can use math to marry both technicals and fundamental factors in a way that can, maybe put you in a better position on either side of that move.
And you guys know better than me. It all is a function of how rich the person is and how much assets are in one. If you got Mr. and Mrs. Rich Bags who are 80 with $200 million at Microsoft stock, they're solving a different problem than some guy. It's all a function. What's the charity? What's the taxes? So it's really hard to make a blanket statement about that. But I definitely wouldn't be saying let me sell my S&P exposure because
let me give it something else.
Breadth metric from 1929.
You might like this. You might not.
Yeah.
Tell me if this makes sense to you. John, chart 10. Todd Sohn shared this. The semiconductor sector is 16% of the market, the S&P. Energy, healthcare, staples, and utilities are 90%. Talking about touching tips. These things are very close.
Why isn't that rational?
Why is this not rational?
Right now.
I'm asking you guys.
What is the profitability of these staples and utility stocks versus?
I would guess, you would know better than me, that if you add up the profitability, just the earnings, and maybe that's not the right metric, of energy, healthcare, staples, and utilities, especially healthcare in there, it would dwarf semis. But maybe not because of Nvidia.
Well, here's the thing. I'm sorry.
No, you did. I love it.
I didn't mean it. It is what is happening to forward guidance is really what is the driver.
The prices are following
2030. What's the 2030 distribution of outcomes?
Yeah.
And what's the constitution? The S&P is a quirky index. It's 35% the grade 8, Broadcom plus the other 7. It's probably 60% an AI ETF, semi ETF. I mean, if you take like GE Vernova and Vistra and Constellation and
all AI.
and Eaton
It's
and
all- right,
electrification and
They are
CAT.
derivative
So-
beneficiaries.
so, like,
Tons of
whose-
industrials.
What he said straight. It's
Right.
about the forward expectations. Like that could be wrong. It could modify itself. But like, yeah, what you just said is semis have been better than energy stocks. Yeah, no shit.
So,
But like,
is there an
the
upward,
hold on.
Is there an upward
The
bound to this?
probability you were going to show a chart that I wasn't going to shit on was incredibly low.
especially from a competitor.
Yeah, I don't even know what that is.
Is there an upward bound to this?
Of course.
What is it?
6 months
Semis-
before
semis
semi
30%?
estimates to prove to be too high.
Okay.
I have to disclose that we are happy consumers of strategics.
Yeah,
as
Trev's a
well.
great guy, and I'm not. There's no credit. There's a big world, lots of people doing interesting stuff, but like, I just think when it comes to like statistical significance or this kind of, it's an interesting observation, but like, it kind of makes more sense to me. Like you asked me a while ago, like, is this the craziest thing you've ever seen? Like, I've seen a lot of crazy stuff. Not really. It's more crazy to me when like zero revenue stuff goes crazy, or like that's a little bit more weird to me than Micron trades at 4.5 times next year's earnings. The earnings are 100% higher than they were a few weeks ago. And there's a shortage as far as I can see in their core product, and you can't produce anything without it.
How does a price find balance? Like, I know it's when buyers and sellers, sort of match up, but like, how should investors think about, I can't buy this now?
So
Like SanDisk, Micron, like
Usually, this is just the fact of the matter. The price movement, once it starts, until something knocks it off that trajectory.
An object in
say
motion
this
stays in
all
motion.
the time.
I do.
And it's absolutely
You know what
true.
I say all the time, and I say this on the show especially. People say I took a profit. Nothing wrong with taking a profit. And then I look at the
Sure there is. You pay taxes.
That's
you
a great
miss
buy
it.
signal.
I look at the chart, and the chart always looks like this grind higher. And my comment is like, okay, but why today? Why don't you just trail it? If you're nervous, throw like a 10-day moving average stop loss, trail it behind the share price, and let the market take you out. Why are you deciding that this is over?
Just evaluate the sell X post and say, did my sell work versus some comparable basket beta adjusted, and that destroys value.
That was
you
not
look
even
at
English.
the
I love it.
Yeah, what? That
I'm
was
saying, like, do
amazing.
real work. Like, do real work. Evaluate whether that
shit.
trading decision makes sense. Like, we're all agreeing. I just, we do this for a living. I get people's portfolios.
I'm saying you have a stock that's been going up for 3 years.
I'll say
Today's the day you took a profit.
I'll say it differently. Do you think if you buy stocks that were just up 100% today, you'll make more money, or should you buy stocks that were just down 50% the
Up 100,
previous year?
obviously.
Up 100.
For sure.
100.
Obviously
cares?
to who? Not obvious to everyone.
Who cares what it already did? All you're trying to think about is, what do I do today and what's going to happen in the
You
foreseeable
care
future?
what it already did if it's gone parabolic and you're the last asshole buying it. If it's a grind higher that took time, I can buy that chart.
Yeah,
and
not
I do.
Not a stock that doubles in 3 months. That's different.
It's the rate at which it went up.
Actually, I'm not saying I'm surprised, so there's no surprise in my voice, but you actually had a good idea there, and we'll study that. We can look at like stocks that have gone up.
Oh, I've already done this work.
100%. And
I will send you my work on the subject. It's called The Best Stocks in the Market. I will not get bullish on a stock that just went from 30 to 60 in a week. I understand it could go to 90, but if you just don't do those and focus on the stocks that climb,
But
that's institutions.
you know what? You can't study that because a lot of the stocks that go from 30 to 60 today, that's the meme shit. And that didn't exist in the back tests.
Okay, so we can study that. We can study every
I'm saying it's a
stock
different.
ever.
No. I'm just saying.
Don't challenge me.
Dude, my
Make
point,
some stuff that
my
makes sense.
point is there was no, the Reddit boards were not here in the 80s.
Can we do something that you just wrote up? Spinoff Playbook?
Yeah.
Okay. This is original Adam Parker research. All right.
Variant.
I'm gonna quote you to you, and then I'd love for you to go off, King.
Hopefully this isn't as bad as my healthcare call.
All right. No. You said in 2025 the median spinoff reached a 26-year peak transaction size of $3.3 billion across 11 transactions. So far this year, only one spinoff has been completed. It's Comcast spun off Versant.
Right.
Okay.
Channel you and I both go on.
That's
Yeah.
right.
Yeah.
But two have been announced, MSGS and GPC, which you'll tell us about. Several more are rumored. 20 spinoffs were announced in 2025 that have yet to be completed, and 6 of these companies are mid-cap or larger. In today's research, we provide context around the spinoff performance, analyze historical market reactions, and supply our playbook for the future. I want to say one thing before you go.
What is a spinoff?
I love spinoffs dating back to my time as a retail broker, telling stories, begging for money. We pitched the parent companies of spinoffs ritualistically. Almost didn't matter what it was, because the pitch to the people on the other end of the phone was, you own 3Com? Guess what? You're also going to get Palm. Like that would be, and people, wait, I get
People
two
love catalysts.
I get love a catalyst, and I get 2 stocks for the price of 1. They didn't understand the fact that the price of the parent would adjust on IPO day. They just love the idea.
Remain co.
Wait, Rob, for Adam, for real, I know I called Rob. Adam, why do companies spin off companies?
Usually, I think the primary
Unlock shareholder value
would be a tax reason, right? It's usually a tax reason. So, like, if you meaning like if I'm, we both used to work at Morgan Stanley. If I'm Morgan Stanley and I sell Discover because I made a ton of money on it, if I sell it, to somebody else, I have to pay taxes on it. If I spin it, there's a massive tax. So there could be, I would say that's the primary driver, but it could be unlock value. You think there's an underappreciated asset. It could be that there's
new management of the SpinCo, which would be more focused on that one business.
Capital structure optimization, dyssynergy. Like there's a list, but
valuation.
But I would say, I would say taxes are usually the driver. Now, I guess, like there's a lot of things you like. First of all, like what you used to sell, I would say I can empirically show is not a good idea. The SpinCos do better than the RemainCos.
I'll go back to 1998 and apologize to people.
The SpinCos typically on average do better than the RemainCos. But it's an interesting point you're making. You made me think of something really kind of interesting, which is one of the signals that works in quant, and it's kind of pesky and it works, is a signal called low price. So we think about how stupid that is. Like low price means it's no denominator. Like just generally like stocks with a lower price, stocks with a higher price. And you could study that
because retail people like to buy low price stocks.
They think it's like $2 is better than 4, independent of like denominator.
Yeah, buy low.
So your logic of getting 2 stocks instead of 1 is kind of funny and probably used to work.
It did work.
But recently in the last decade plus, since there's been like computers, the SpinCos usually do better because typically when they spin them, they know the numbers and the estimates are pretty achievable for the next couple of quarters. They have a path toward margin expansion or something the market likes. And usually they're spinning something in a different industry. So, there's some rationale. I think, we have a lot of clients that are law firms and boards and managements of companies. And I think they're just all looking to unlock value. If you're a 40, 30, 50 billion market cap company, 20, 30, 40, you're sort of thinking like, is there a plan I can get like big? Can I get to 100 billion someday? How do I do it? How do I unlock value? And so you're just looking at transactions. You're just saying like, can I buy something? Can I sell something? Can I do something with my capital structure? And I think more importantly, if you're a good person, you probably want to be perceived as a good steward of capital over your tenure managing the company. So I think SpinCos are topical.
So you're saying the spin is better than the parent? Or the parent's better
on average,
than
the spin's better than the RemainCo,
but
for
on average,
return.
But on average, is tricky because some of these are so specific.
I think generally you want to buy the SpinCo, not the Remain.
Okay.
Yeah.
It makes sense to me just anecdotally thinking about some of the big winners from spinoffs that I like. Zoetis coming out of Pfizer.
GE Vernova.
GE Vernova is a monster. Like some of these I think of are 10 baggers. And I remember what they came out of.
The original 12-month performance out of the UTX spin where you got, Carrier and Otis and
SanDisk was it a 2025 spin or a 2024?
Maybe
2022, I think.
Yeah, a couple of years ago. Yeah.
Okay.
We just think generally, like if you're a human being analyzing stocks, like where can you add value? Machines are going to kill you in a lot of places, but humans are going to add value whenever there's like a management decision making, creating or destroying value. So I love analyzing stuff like M&A.
Can we show your charts? Can we show?
Shit, I know
we got him.
I know you had me. Oh, great.
All right, John, let's go through this. You could just narrate for us, like briefly, what each of these.
I'm surprised you find this is super interesting. I mean, thanks for anytime you throw our work on the screen. I'm
Trivariate, ladies and gentlemen.
I'm all in. Thank you.
All right.
No, I just think that like the law firms and the bankers are pitching management teams on doing stuff, and one of the things that they can point to success for is spending. And I just surprised there haven't been more. You can tell on the left, there's been 20, 30 of these things a year, and there's only been a couple recently. And I just feel like there could be a wave of these things going forward. Generally, mid-cap companies do it, not mega-cap companies. It's kind of
look at the returns. SpinCo is black, RemainCo is blue. And I mean,
maybe I don't know what the next slide is. Can you show me what else you download? A couple more, maybe go flip ahead. How many did you take?
every single thing
All right,
that
go,
you ever
keep
did.
keep going. I'll show you the one.
Even the ones you didn't publish, I found them.
One more. Keep go. See what you have. Keep going. So I think there's like a line chart. Yeah, the one on the right here is the mean industry group relative return. So this is how the stock did versus its industry. Because I didn't want it to be like SanDisk was awesome and you're not normalizing for the industry, right? So the black line is the typical SpinCo performance, and that x-axis is the number of days. So like kind of 252 trading days in a year. So 2 years out, the average spin beats its industry by 10%, and the average remain kind of lags by a couple. So
I mean, that is statistically significant.
Yeah, it's a real number,
and that's robust across sectors.
Pretty much, yeah, pretty much.
I mean, okay, love it.
Yeah,
well done. Right. Now, Rob, would you like to unveil your research on spinoffs?
We don't have that in the bag. It's Trivariate Research.
But you know, whatever.
Why would we do it twice?
Yeah, exactly.
I wanted to ask you about some of your favorite stocks this summer.
Mm-hmm.
So you and your team gave us a couple to talk about. Let's hear what you think.
Hold on, we're skipping spring. Is this like these are only going to work in the summer?
Yeah, only for the summer.
I don't know.
Buy these until the summer.
I don't know if I operate.
It is hot outside. It's hot out.
I don't know if I can operate with that level of precision. However, I think it's a balanced way to think about how you invest at this time and possibly going into summer. And it's a marriage of, putting together the highest conviction names that are at their all-time highs.
Right.
No question. Married with some beneficiaries of that in energy specifically, and married with, energy, producers that I think could benefit from further crisis in the Middle East. And then for the sake of Adam, we put in Gilead because we think you got to have a healthcare name in there.
Yeah, like it.
And so you're putting weight on two different skis and adding something a little different that I think is reasonably attractive.
Yeah, Broadcom here, king of this is from your team, king of custom silicon, data center networking infrastructure, positioned to win as hyperscalers spend more. I mean, this stock has obviously been a huge winner. I know you guys have made a lot of money with it. You still like it here?
We do. It's the object in motion stays in motion. They're on track for 60% revenue growth this year. They have industry-leading profitability. They're a leader in both custom silicon data center networking hardware.
The market is not stupid.
Could you have more
taking this stock to where it's taking it?
No, not at all. I think where the market was stupid was in April of 23, where you had all the other names doing what they were doing, and this one was left behind, and it was trading as a teenager.
Oh my God! I just said it's at $1 trillion. It's 2.
Yeah, it's unbelievable.
Lam Research.
Nvidia is 4.8.
So I love this. I love this stock. It's up. We wrote it up for best stocks in the market last August. I think it's up 170% since then. I want to point out we wrote it up at an all-time high. People were angry. Like, now you're saying you like it. It's up however much. It's up another almost 200%.
I always like stocks at higher prices than I used to not like them.
It's up 297% over the last year.
I mean, they basically control their entire business.
Quasi-monopoly.
Right.
They're essential in the chip manufacturing equipment.
What is NRG?
So NRG's a derivative beneficiary of what's happening in AI. Power's the bottleneck.
Yeah.
Vistra Energy as well. We were on Vistra. We had such a move. It was, I think, the number one performing stock. I'm trying to think of the
VST. That thing was insane.
And we bought it in January. At the end of the year, it had moved so much that we decided to diversify because NRG was lagging. So we kept Vistra. We added NRG under the same portfolio theme. It's down from its highs in February. It's down about 20%.
Taking natural gas and getting that into the electricity that the data center needs.
They need it. And they're big in this bring your own power deals where they sell directly to the data centers, which is kind of a unique and novel strategy. Yeah. And I think it's going to work. And it's trading at 16 times right now.
APA.
APA is more of a
blast from the past for me.
Yeah, just an E&P name.
Yeah.
It is up 58% year to date. It's off 14% from its recent high.
Do you need Iran to stay up to stay long this stock, or do you like it either way?
You need things to not open quite as quickly. I think this is going to be a beneficiary of America doing what we're doing from a production standpoint. And it's a great combination of a lot of diversified production across regions, products. They have a healthy total yield, 12% between buybacks and dividends. It trades at 7 times.
It's crazy.
This is an interesting business to us. And then lastly, Gilead, which has...
You did that for Adam?
Well, yeah.
Diversification.
Diversification.
No, the stock looks great. It's actually been a strong in this group. The group has sucked for a while.
But this
has been one of the good ones.
This is one of the winners. I think you have to have some exposure in this space. Again, this is the upgrade in the quality. They're dominant in HIV. They're doing unbelievable things in oncology. They have 50 drugs in various stages of development. They're enormous, and you have to be enormous to be able to do what they're doing. And there's upside in their pipeline based on progress. So we tried to think, I asked the team, this is not me, I'm going to take no credit. This is Jay Peters, this is Cameron Dawson, this is Brian Nick, our investment team. They're super. And I asked them, I said, I want a balanced view where you have option. We can ride the current wave we're riding. You have optionality to the crisis. So 3 names ride the current wave, right? Power, and then the 2 semis. You have option to crisis in the Middle East. And then we get some stability where you're not going to have a lot of price performance. We want a healthcare.
Are you surprised that the healthcare stocks aren't getting any credit in advance of being perhaps the biggest beneficiaries of utilizing AI?
So look, it's been our...
Why aren't people figuring...
It's been a Bears overweight call.
Out?
It's been a terrible call, unlike the software one. This has been a bad call. And I trying to figure out like what could untether me from the thesis. I'm trying to be like intellectually honest. Like, could anything change my mind?
Long term should be no, by the way.
Yeah, and I'm worried about it because I don't want to be the jerk who just...
Is that your thesis? So that AI is going to be one of the bigger for these companies than most?
So what the market's telling me is there's a 0% chance healthcare is the best performing sector over the next 5 years. And I think it's like 30 or 40%. I just start with like, I want to arbitrage that difference. Okay. I think the whole point of all of this shit is that we live longer and we're more productive while we're alive. So if I take that premise, I don't understand how healthcare revenue per share is going every year 30s in a row in the S&P 500. We have lots of old people that demand services, tools, diagnostics, drugs, managed care, hospitalization, whatever. That's steady. We have tons of businesses with lots of employees, low margin, and lots of revenue, meaning as long as I can predict my customer employee behavior, margins should go up. It's a classic AI productivity potential. They do, as he just pointed out beautifully, have low correlation to AI semis. So you don't want to buy low correlation, meaning like they suck. But there are a bunch of healthcare stocks, Lilly and others, that are up 10% or more in the last 6 months and are uncorrelated. There's some good stocks. So there's some of them could work. I'm very tethered to the thesis and bullish. And I do think—
It makes sense to me.
Which names do you like?
It's just not working.
McKesson, Cardinal, Cencora, Quest, LabCorp. You know, even stuff that blew up recently because like you're still young.
How
but
about
like,
the big
you
pharma?
can't go to the
GLD?
doctor and not end up sending something to LabCorp or Quest. There's 0 chance they won't grow above GDP. And there's still dudes with like, when we were kids with the glass microscope, with the thing, like the efficiency potential is massive. Yeah. Right. And I would even say managed care. UNH had a good point this week. Stock was finally up. Like, I run a business.
I'm not brave enough.
Let me tell you who raises pricing on me 9% every year. And guess who doesn't give me 9% more services? So like, I think they're going to earn more money in 2030. And I don't think there's any political will from either side to change the algo. If you tell me that some party's going to come in and implement massive austerity, then I'll change my mind.
So it sounds like healthcare away from big pharma.
I think there's still some good big pharma. I mean, I'm not against Lilly and Merck and other stuff.
Lilly's unbelievable.
But I'm not embedding yet. What I'd like to do is be correct on a 5-year view. And then there's all kinds of like computational chemistry ETFs that retail guys are buying. And I'd like to sell my correct overweight into that euphoria 5 years from now. But I got a lot of good shit's got to happen before I get to that call. Yeah.
I want to ask you about NewEdge and founding the firm, and Adam, by all means, chime in. Like, when I first met you, you were UBS. You had one of the biggest teams in the firm. Mm-hmm. You were not talking about going independent, but I'm sure you were thinking about it, as most people at large firms often do. Mm-hmm. What have you learned since coming into the RIA space? Obviously, you've built a massive platform, big firm, hired a lot of people, met a lot of people. What are like some of the things that you think you've learned in the last couple of years since doing that?
Well, first
What
off,
is it, 4 years ago?
5.
5 years. Okay.
Five years ago, and we've grown from 8 billion to 105 billion in assets. So
Amazing.
it's
Congrats,
been a.
It's not as good as Micron. It's not as good as Micron's earnings, but it's pretty good.
But I think the things that I've learned are one, there's a lot of noise in the ecosystem. Not everybody says it can do what they say they can do. And what that does is it creates a lot of paralysis in this migration that we're seeing from advisors at big firms to advisors at more entrepreneur. I mean, look at what you've done here. I walk into this office and think, oh my God, this is great.
Yeah.
I mean, you're adding value in a different way. And you're adding value by sitting center. And when you're a client of the street versus a competitor of the street, you have a structural advantage that's very meaningful. You don't have one arrow that you can pull out of your quiver. Let's say you were doing a loan for somebody. You're going out to multiple providers. You have tools.
So if you're sitting at Goldman Sachs, you're doing that loan through Goldman Sachs. If you're a customer of Goldman Sachs, give me a quote. Okay, I'm going to go to RBC, see what they say.
You're not with them.
Yeah, I agree with that.
You're across from them.
I agree with
and
that.
yet NewEdge is a gigantic client of Goldman, JP Morgan, all the different banks,
Right.
all the different capital markets groups, all the different asset managers. And I do think size and scale matters. There's something else that's kind of happened in the industry, and I don't want to mask the good fortune and luck that I had in doing this in 2000, just as this was taking off at the higher end, not 2000, 2020, at the higher end of the market during COVID. It looks easier than it is.
Oh, I couldn't agree more.
And,
Say more about that.
And you need a good partner. So I did not start NewEdge. We did an LBO of a business with a tremendous partner in Parthenon Capital. And that operating business threw off cash flow. Again, it was an infrastructure business, providing institutional grade infrastructure in the 401k industry to Fidelity, John Hancock, Paychex, Creative Planning. And they had a great business, but they wanted to do something else. So we bought the business and we built a wealth business on that same infrastructure that was bulletproof. Cheating, starting halfway up the mountain. I didn't have to go in and worry about, did I had a tech team? I had not only a tech team, but I had profitability to hire the best and brightest.
Right.
Okay. So the good fortune that came from that simple decision of not worrying about how my computer was going to turn on in the morning. That's why I love these entrepreneurs that do this grassroots and bootstrap this unbelievably hard.
But it's way harder than it looks.
And now you have partners that can help you get from A to B. So when I think about what we do is we have a fully evolved ecosystem where you can join us and use the platform turnkey. Here's everything. You got all the support, the compliance, the anything you need. Or we are going to sponsor you in your entrepreneurial endeavor. And we have the best business in the world to do that that's run by my partner, Alex Goss. We also had some very fortunate hires and partners in this business. Chuck Warden, who was the founder of the business that we bought, Parthenon, who's the private equity firm, John Strauss, who ran every major private bank on Wall Street, JP Morgan, Morgan Stanley, UBS, ran them all. Bob McCann joined us. So
UBS.
we had UBS and Merrill Lynch. So we had these credentialed folks that when you're looking off the cliff and you're an advisor and you're getting ready to jump, you still can't see the bottom. Okay. And you want to know that there's knowledge, know-how, and people down there that are going to help you navigate every decision, whether you're starting your own thing on our platform that's run by Alex Goss,
to that point, like somebody coming out of an environment like a Bank of America or a Morgan Stanley, there might be things they don't love about those banks, but the one thing that's undeniable is they have a ton of support. Like they don't wake up in the morning like it's my whole.
That's what was missing in the marketplace is this fully supported DNA. And so I'm no longer the CEO. You introduced me as the CEO. I am the founder. Okay. So I made a big hire last year.
You hired somebody to talk to to speak to that CEO role so that you could be Rob Sechan.
I can be Rob Sechan.
I did the same thing.
So it is a great thing. We hired James Jesse. You know him from Morgan Stanley days, I'm sure. James Jesse ran Morgan Stanley International,
Right.
but then he went with Devesh and helped start Iconic. Okay, he wanted to come back East Coast. That was our good fortune. We also, because of the profitability from the business that we bought, we're able to hire people like Cameron Dawson, who I think is one of the most fascinating thought leaders
we love Cameron.
in the industry. So when you marry all those things together and you can create an entrepreneurial environment that is doing the right thing, and trust me, net present value of doing the right thing creates more value than anything. So great technology. They're not rolling out Enterprise Anthropic. Not a single firm yet. They're trying it. We are fully rolled out.
Right.
They're not using tech that betters price, execution, visibility, and assets. They're not partnering with Adam. They're not partnering with Tom Lee. They're not working with families. They're not surrounding those families with high-end intellectual capital, and they don't have access to each other's shit. And we have access to everything. And so when you have a better mousetrap, it is undeniable that the migration will happen when there's more confidence and less confusion. But everybody tries to tell that story, and not everybody can deliver that story. And as such, advisors haven't moved in mass yet. Once a few of the big ones fall, as you know,
You
Josh,
think the wirehouse exodus hasn't even really started?
it's here.
Really?
Wow.
Because
So the corner
I know
office
I know 5 guys that were $5 billion plus teams, duos, just at one firm that have left in the last 2 years. How many more could there be?
That started about 2 years ago. You can't believe our pipeline.
Yeah.
You just can't. And the one thing that I would say is firms that can't address the entrepreneur that wants to have their own CIO, not Cameron, and others that want to have that.
Yeah.
We have those bookends in a leader that has operated in the wires and in the probably one of the best firms in the independent space and Iconic. I think that is confidence inspiring. And I think, we've become a partner of choice. I mean, it's growing at 70%
if you have
per year.
advisors, if you have advisors in your ecosystem, let's say you had.
By the way, I just want to say that was like a highlight of this
Great speech.
It was just electric.
Yeah.
I'm just saying.
I'm
I mean,
really
it, like,
passionate about this.
No,
company.
I loved it.
love
I just think like you. I'm not saying the stock part wasn't great, but I'm just saying like the EQ IQ combo that just came out from describing this business was electric.
That's why I do more
I'm
of that.
being serious. I'm being serious. You felt it, right? It was just all of a sudden a fuse got
He was
lit.
cooking.
It was awesome.
If you have an advisor who's a card carrying NewEdge, like all the way in, who comes to you guys and says, you know what, this has been great, but what I really want is to have my firm under its own name, have my own CIO. So now you have a place where that person can go where they don't have to leave.
Come in straight.
So I think that's powerful.
Right turn, left turn. We have businesses over here that we bought into card-carrying businesses. Remember, when we buy you in, you are owning the same stock that we did in the LBO. No difference. Not like some of the firms that had failed in the past. We have the advantage of being the vitamin water versus the Gatorade, right? And all this. We second mover advantage, and it's been pretty powerful to identify the flaws of our predecessors. And what ends up happening is if you just do the right thing for the advisors, meet them where they are. I think you're advantaged in this too, guys. You're a firm that was started by advisors for advisors. That is a huge advantage because why are you going to do something that damages yourself? Now, what I recognized is there could be a better day-to-day nuts and bolts leader than me. I am a champion of the organization. I have one concern. How do those advisors that believed in this field of dreams that we bought and built, how do we drive value for them, both in their practice, in serving their clients, and then ultimately in the equity value that they've taken on in our company? And I take that very seriously. And if it means shooting myself,
I don't
care.
So this is a very
Wow.
big thing. It's a very, by the way, very well done.
Thank you.
This is a very big thing. At a certain point, you have to make the decision, what is my highest value to the firm? Is it sitting in 8 meetings a day and micromanaging 50 people or is it being me and bringing in professionals to handle the
I think no
details?
matter what you do, you have to think about that right now. Obviously I'm in a different business and it's a small scale, but like we have guys who like whenever I've become very self-conscious about this. When I'm in front of my computer typing and one of the quant guys who works for me is standing behind me, I know they're thinking like, this guy doesn't know how to use a computer. Like the best use of Trivariate's time is not when I touch the keyboard.
Not when you are grinding
I'm physically
through,
doing
right.
it. If I am doing something, they're like, no, don't do that. And so I started to realize like, all right, like we got, and it's like, and all this AI stuff too, like it's like we got to be, so I don't know. I mean, that's honestly, I never really heard you articulate that. I'm not surprised at all, but it was awesome listening to that.
You like the entrepreneurial part though of what you're doing.
I love it. I totally love it. I don't like,
you're not one of these guys that's like, just let me do my research. Like you actually enjoy building the business.
I do. I like thinking about what the enterprise is going to look like. We have this newsletter business that you know about Trivector. We've got, we'll probably end up doing, some stuff on the asset management side. I'm doing some stuff with investor relations. I do stuff for law firms and boards. I'm joining the board of a public European company next week is when it's official. So like, I'm just always trying to do new stuff and learn stuff. And I'm like kind of I like doing the work and I like talking to people.
Other guys who sit in your old seat as chief strategists on Wall Street come to you and say, hey, what's it like being independent? Like
it's a little bit like your conversation you were just having, which is like you might have disgruntled issues with the big firm and the big necessities of the big firm you work at.
But you're getting a lot from them.
But you're also getting a lot. And so when you go on your own, like you're going to be washing the dishes and putting the mayo on the sandwiches the first couple of years. And like you've got to decide like, A, am I rich enough to take the risk? And if it doesn't work, and B, like, or whatever. There's like considerations that go into it. Yeah.
Michael and I were literally licking envelopes. In real life.
We don't have a dishwasher at Trivariate, and like all the young kids don't understand that like I'm the one who washes their mugs, and that's like today. That's still like so so like whatever. Like you gotta do that, but like at the end of the day, for me it was worth it. I was at the point where I wanted to take a shot, and I love it. But like I love listening to you guys talk about the 5-year plan.
Everybody does it differently.
Yeah,
but I don't know anybody that would say I want to go back.
I wish I could go back. I've never heard it. It's like moving to Florida. Does anyone say, shit, this is terrible?
You're talking to a guy who's on a 720 tonight.
No, I know. Hey, last thing we wanted to get to. BMNR. Okay, so Tom Lee launched how do I explain it?
It's an Ether treasury company.
Yeah.
It's like a MicroStrategy, but for Ether.
All right, so Tom Lee launched. You got added shortly after.
And they're doing. That's what they're doing, right? They're
it's
like 5%
a
of all
digital
outstanding
asset
Ether.
treasury company. I think Ethereum's a bit different than Bitcoin rather. BMNR is Bitmine. When I looked at this, I thought this was a charlatan's game for a long time. I even shit on it on TV.
And then you said, let me in.
Well, then I started to do some work. I started listening to Tom and seeing the things.
You thought MicroStrategy was bullshit.
No, I just thought the whole ecosystem.
The whole thing.
Yeah,
Okay.
I was a non-believer.
I still think that.
Now I'm an evangelist.
Why? What changed?
And I'll help change your mind. What I'm seeing is a misunderstanding of what certain parts of the crypto ecosystem are. And I think people think crypto is like a coin. It's infrastructure. It's a value-added network that you build apps on. And anytime you drive usage, which is why BMNR bought Mr. Beast, visibility, usage to the network, you can profit from the network. And when you think about what's happening in traditional finance, it's fragmented, it's intermediaried, and it's slow, and it doesn't run 24 hours. And every one of them is trying to figure out, how do we get to tokenization, digitization? And they don't know how to do it. And Ethereum flips that. It's the safest of all of them. It's programmable. It's real time. It's always on. And BMNR is a holder, and why they got me involved is there's a huge gap between institutions that have capital and they need help to translate it, structure it, and make it usable for them in traditional finance. And the next phase isn't about speculation. It's about integration of the financial services platforms onto an entirely new architecture, okay? And when you start to see what's happening in that community, and you start to see how it's being ignored by TradFi, is what they call it. DeFi being ignored by TradFi. And there's a bridge of the gap between the two.
I keep hearing this. The New York Stock Exchange just says they want to be the capital of tokenized assets, right?
They'll build that on Ethereum.
They will.
So why not just buy Ethereum if you're bullish on it?
You can't. And that's the beauty of it, right? That's the beauty of it. Because what you're becoming when you buy, let's say, BMNR, and I'm not promoting BMNR, any source of Ethereum, but that's what I know because that's the company that I'm the lead independent director on. They are doing things so that you can earn what is called a staking yield. You can make investments into businesses that are going to be beneficiaries. They call it moonshots. They invested in Mr. Beast.
So if you own BMNR, you get the benefit, if there is one, of the investments that the company is making.
Yes.
It's not just the price of ETH going up.
And by the way, when you validate, and they have a whole business that they call Maven, which is a validator of transactions, and you get paid to validate, you are getting a 4%, 4% yield. And so
you're earning the gas fee.
You're earning the gas fee.
As a node.
So you're becoming a toll road.
Okay.
And then what you want to do is ensure usage. And that's why I use this as the example. Apps are being developed. So layer 0 is kind of the foundational layer. Security and transactions happen on that layer. Then layer 2, or apps, or dApps is what they're called. Sorry, I didn't mean to spit on everybody. Are being built to do functional things, specialty nodes on that. And it's going to happen quicker, more safely. So when you think about the threat that AI has to everything in technology, wow, wouldn't it be great to have this immutable safety layer that sits beneath that? And so I'm going to tell you, I believe in this wholeheartedly. Now, there's others like Solana that are trying to do this more cheaply, but the bulletproof version of this is this. Tom Lee sees around corners. We already know it. He's seen this years ago. Ethereum as an asset, you can own the token, which will give you that yield, to your point, Michael.
Adam, how out are you?
He's not in yet. He's not out.
I'll go with a crazy pitch of a different kind.
What does that mean?
I'm gonna pitch a stock of a different kind. I'm gonna try to. I think Nvidia will be worth 10 trillion market cap by the end of this decade.
What is it now?
4.8.
Okay.
And I think like it's misunderstood a little bit. I think it's a sector. It's not a stock. I think it's really hard to get off the CUDA.
It's a sector.
I think it's really hard to get off the CUDA platform. I don't think that like you can do anything kind of modeling wise in AI of scale without
everyone working in AI is on that platform.
They lost money for 15 years coding this CUDA stuff. Like the amount of install base that's there, they're moving full speed ahead. Like it's just going to be hard to get off it. They're going to grow 15% a year for 5 years. The revenue is going to double at least. The cash flow is massive. And anytime you get one of these like 12-month periods where it like pauses out, it's a good time to buy some before it like flies.
I'm
higher.
not selling any.
Yeah. So I just.
You and me got on that.
I don't
never
see,
selling it.
Like my view is like, yeah, sure. Tactically, I don't like it when they blow out the quarter and the price to sales like comes in and it acts. But like, I just think they're going to grow way faster.
They have
than
to
people
buy
think.
back. Do you think they're going to ever buy back a meaningful amount of stock? Seems like it's the lowest valuation Nvidia has traded at in a while.
Just keep investing upstream and downstream. They're gonna the constraint is the power side, right? Like we talked about earlier. Like so they got to make sure. But like, how can you function and do anything without their infrastructure? So like, just think of it as a sector. Like, stop telling me it's 4.8 trillion and it's bigger than the energy, healthcare, and utility. Like that doesn't matter. What matters is it's a sector that's massively fast growing to the technology that matters.
The
the
bear
most.
case on Nvidia was all these deals are circular, blah blah blah. No one's saying that anymore. The bear case is now.
How about all the big companies? The bear case was, I think, one of the bear cases that I don't like is like, oh, all the capex comes from hyperscalers, and it's like 6 companies. It's like, no, it's not. AWS, like Amazon, isn't one company.
Like 80 million customers,
thousands of companies. Yeah. So it's not the right way to
bear
think about it.
case is that TPUs from Google and other competing things will
They're not on
be.
CUDA. It doesn't matter. It's like
okay.
great. Like, look, those of us who've followed it, Jensen for 25 years would say like, sure, there's a lot of like bullshit that he spewed in the 25 years. Like, I'm not saying, but I think there's really just the installed base of folks who are on this platform and the investments they made up and downstream. So like, yeah, I don't see how you could be bullish on the S&P 500 in a 3 to 5 year view and not be bullish.
Well, I was
going
to say, if you think Nvidia is 10 trillion, then surely you think S&P is going to 10,000.
Yeah, they're both. I wrote the S&P was into 10,000 3 years ago. I wrote 3 years ago, 2030, 10,000 for S&P, and I think it's not even
conservative.
It's not even like weird math. It might be conservative. I mean, where are we? You're talking
7,000?
35% in 4 years. That's
not far.
That's the S&P long-term return is that.
Right.
Yeah.
All right.
Just sounds like a headlining number.
Guys, do we have fun on the show today
Awesome.
or what?
We did.
Yes.
Hey, I heard at the beginning of the show with Tom Lee, you were making a little fun of me with my accent, wondering where it was
He does a good Rob
from.
Sechan.
I do an amazing
Do it.
Come on. I heard at the beginning of the show with Tom Lee, you were making a little bit of fun of me.
Did you get? By the way, did you
Where
get?
the f is your accent
you're from
by the way?
Pittsburgh. Makes no
I
sense.
am from
Why
Pittsburgh.
do you talk like you're Foghorn Leghorn if you're from Pittsburgh? I don't even understand what.
We have a guy.
You see here.
That's got to be the title of the. You guys are always looking for a title. I think Foghorn. I think you just got it.
So what happened is I got very confused.
You. I'm allowed to do it.
I got very confused. I grew up 26 years in Pittsburgh, and then I moved to Connecticut, and they didn't mesh well.
By the way,
I was a yinzer that kind of de-yinsed my
Josh,
language.
I win our side bet on the number of times he was going to mention Tom Lee on this call. I had 9, and he so I get a little vig.
Can I say one thing to you? This is a true story, and I never told you. You and I have had some of the all-time great brawls on Halftime Report, all in good nature.
Yeah.
Is that right?
Yes.
I've never
I
seen
didn't
one.
know that.
Yeah.
I know that because I keep track. I write them down each day.
We've never had. You and I have never had one.
No,
Yeah.
you and I are golden.
Yeah.
No, but Rob and I are good too.
Is Rob a dick? Is that what you're saying? Is this coming out now? Is there latent?
Sometimes, listen, we're on
Is
the
this
show.
where I get body
Yeah, what's
slammed?
going on here?
No. You've been on the show for a long time, since we were in Englewood Cliffs.
Yeah,
Yeah.
13 years.
There was one time where you were saying something, and I wasn't even on the fucking show, but I was like tweeting at the judge, and the judge texts me, goes, "Why don't you come on and you and Rob can have this? You and Rob can have this." I don't know if you remember this. People won't believe me what I'm saying. I was literally in the gym at a hotel. I must have been in like Arizona or something, because I remember looking outside. It was a sunny day. It's 12 o'clock in the afternoon. I swear I was working out. I swear to God. I go live on the show. Other people are in this hotel gym looking at me.
Wearing like Lulu?
And I'm
or what?
debating you. Anyway, this is the point of the story. Somebody that I'm friends with texted me and said, when you and Rob go at it over a stock, nothing ever besides a stock, he goes, it reminds me of fighting with my brother. Like, you guys are like brothers.
That's nice.
I never told you that
great.
story.
That's really cool.
But I think you're a brother. I really do.
I appreciate
I
that.
love the debates that we have.
Me too.
It sounds like these days we agree on a lot of things. I agree with almost everything you said today. And thank you so much for doing the show.
What I agree with?
I appreciate
I agree with
it.
105 billion and a lot in the pipeline. I agree with that.
I very much agree with
Do you agree with that?
Who
How do you agree with
who could deny this success?
Do you agree with that?
I agree.
Yeah,
Fully
no,
agree.
thank you so much. It was
fun to
really,
be on with you.
It was
Yeah.
really fun being here with both
do it
of
again.
you. This is a great program.
All right, well, we're going to come back from dinner. We're going to do the second half of the show. And, guys, we
Awesome.
appreciate you. I want to let everybody know they should follow Adam and check out Trivariate Research and Trivector Research.
Yeah.
Who is that for?
Trivector Research is for advisors and individuals. It's a
Financial
$1,200 a
advisors.
year. We do a lot of like ETF analysis, insights, videos, talk about what we learned for institutions. So I'd love for people to join.
Awesome, dude. And if you want to learn more about NewEdge, go to newedge.com.
www.newedgewealth.com.
NewEdgeWealth.com. All right, guys, thank you
Awesome.
so much for watching. Thank you for listening. Special thanks to Adam Parker,
Love being here.
Rob Sechan. We'll talk to you soon. Take it easy.